Let's bring in Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, great to see you in person.
Happy New Year, guys.
In terms of, we were just talking about, what the markets believe in terms of not believing the Fed, not believing the higher for longer. Who's going to win? Because it feels like, Fed officials want to come out and say, you know what, this is happening, this is happening, this is happening, and the market's not pricing that in.
Yeah, I think it's been a really confusing period for markets. I mean, at times, you look at the last couple of months, you've had this massive cyclical rally, spreads have come in, so off to the races, right? Growth, we're probably going to have a soft landing, but at the same time, there's all these concerns about a recession, and I don't know what the market's really trying to price in. I think at the end of the day, I think if today was really a bad news is bad news market, I think that's really healthy. I don't know if that's the case. As we said, the initial reaction was positive, and then there was some Fed speak to change the tone. If bad news is bad news, I think that's the right thing, because the reality is when markets are rallying off of bad news, that's a myopic view of the focus on the Fed. But that's the Fed is a lagging indicator reacting to lagging indicators. The reality is, I can tell you what's going to happen with the Fed, inflation, growth in earnings, and rates. If you tell based on growth, growth is going to be the thing that drives everything this year. That's very different than last year when it was the inflation, when it was the Fed. I think growth is heading lower. I think that's going to not be perceived positive for markets. So at the end of the day, bad news is bad news.
Dan, you've been consistent with a lot of this view, and I it's been right. I look at your notes and I see tech could be down another 50%, 50, not 15, not, that's extraordinary. And I realize there are many different parts of tech. There's the internet, there's certainly, there's cloud, there's software, there's data. Try to define that a little bit more.
Yeah, I think broadly tech, I mean, let's just call it NASDAQ or just anything having to do with tech. If you look at the sectors, the three sectors that have heavy exposure to tech are communication services, information technology, and consumer discretionary. Those three sectors, I think, are heavy risk. I mean, we've only come down from like half of the market cap to like 43%. I mean, there's definitely a lot more room. If you think about it, bubbles, which I think it was a bubble, take time. It takes time for people to give up on their.
So this is a market starting, but I mean, so you're talking about the structure of the market. You're saying it was 50%. It's come down to only 43% of the market cap of the S&P, and that's just not the right number.
I think there's further downside because people haven't given up. If you look at the biggest holdings in people's portfolios, that's still where they are. If you look at the most expensive part of the market, that's where they are. Look just at the sheer number of products and ETFs out there. That's where they are. I mean, that's where the focus is, and I think it takes time for people for that mentality to change. If you go back to the tech bubble, you had 16 different bear market rallies over that 2.5-year period. We've had 3 double-digit rallies in the NASDAQ over this time. So I think, again, there's going to be rallies, but I think ultimately there's a lot more pain because bubbles don't deflate overnight.
A lot of people make a lot about fund flows and where institutional investors are, and cash levels are still very high. And one argument would be, well, there's a lot of dry powder. That dry powder, though, can go many different places, not into U.S. equities. So what do you think happens to that dry powder? And why might the bull case, the traditional bull case, that money will go back into U.S. equities? Why can that be wrong this time around?
Well, if you actually go look at cash levels in cycles, you actually see cash levels consistently pick up into and grow into the entire bear market. So I don't think there's anything surprising about high cash levels. And I think where could it go? Well, I think flows follow performance. That's why I don't tend to look at flows week to week or month to month. And if you do want to look at flows, what was the sector with the highest inflows last year? Well, technology. So that should be worried of itself. I think that you're going to see flows. You've seen flows follow markets. So you've seen big outflows after markets have fallen. You've seen inflows because we've had a rally. I think ultimately it's going to take years for the performance to prove where the flows will ultimately go. I think the leadership in the next 10 years is going to be almost a mirror image of what we saw over the last 12 years. And so, once you start to see that 2 years later, 3 years later, then you'll start to see the big flows into those areas.